Thank you everyone for joining. My name is Mike Camara with Bogart Wealth. Today we're going to be talking about net unrealized appreciation and some other post-retirement strategies. So we have the chat and the Q&A. Feel free to type in any questions as they come up. I will pause at the end of this presentation to go over any questions, and if I see them come through during the presentation, happy to address them at that time. So let's go ahead and get started. So a little bit about us. We are a registered investment advisory firm. We have about 2.6 billion of assets under advisement. We're completely independent. We have a fiduciary responsibility, which means that we put our clients' interests first. We're an institutional custodian, which means that we don't hold any money here at Bogart. All of our clients' money is held at Charles Schwab, which is a third party. And then we basically work with a number of different things, complex portfolios addressing unique needs that require a highly customized level of investment expertise, And then we're a fee-only wealth management firm, so we don't have any commissions, no conflicts of interest, anything like that. These are our advisors. There I am without my beard in that picture. I've been doing this for about 18 years. There's James Bogart, president of the firm. We have some of the rest of our team here. You can go to our website and look up anybody's bio that you might be interested in. I'll mention Leah Dwyer. She works directly with me as my associate financial advisor. This is some of the rest of our team, and we're split between Texas and Virginia. This is our investment team located in Virginia. As mentioned, we have offices in McLean, Virginia, Houston, Texas, the Woodlands, Texas, which is where I am located at. Our focus is on comprehensive holistic planning. So we treat retirement planning as something that's never done. You'll notice this is a circle, not an endpoint. So a lot of times we like to start with a retirement analysis, talk about cash flow strategies, tax planning, investment management, estate planning. Then we like to review and monitor. We're not done at that point. At least once a year, we want to update the retirement analysis, see where you're trending. And this is a continuous circle. Do we need to make any adjustments to the cash flow? Taxes are something we have to factor in every single year. Investments may need to be changed, adjusted. Estate planning, laws can change, situations can change where we need to revisit that. And always we're reviewing and monitoring. So this is a continuous circle that, once again, we treat as a retirement analysis, or retirement planning is, again, something that's never done. So this is one of the seminars in what we call our Retirement Readiness series. This is some of the other topics that we like to go through. We also have these seminars that we do, including this one, recorded, and it'll be posted on our website. So if there's one in particular, such as estate planning, that you're really eager to hear about, we have that posted on our website that you can go look at the recording. But retirement planning timeline, retirement income planning, Social Security strategies, tax planning, estate planning, NUA, which is what we're going to cover today, long-term care planning, Roth versus traditional 401k, and one of my personal favorites, the mega backdoor Roth conversion strategy. So the agenda today is to primarily talk about net unrealized appreciation, probably one of the more complex topics that come up in financial planning. So around that, we're also going to talk about post-retirement strategies, estate planning strategies, tax strategies, cash flow strategies, good till canceled orders, which has to do with selling stocks, covered calls, which are options, and then, as I mentioned, have a little time at the end for Q&A. So let's first talk and kind of lay the groundwork around what NUA has to do with and what a 401k is, basically. So want to start very, very basic level. NUA has to do with employer stock within a 401k. So let's talk a little bit about what 401ks are, what the deal is, how they work. So the good part about a 401k, you contribute your salary on a pre-tax basis. Basically, every year you're contributing on a pre-tax basis, you're lowering your gross pay and thus saving on taxes. You pay no tax on any gains or appreciation of any investments within the 401k until you withdraw the funds. No taxes on dividends, A lot of companies offer company match, not all of them, but many do. The other part, there's a penalty of 10% if money is taken out early. Early in most cases is 59.5. There are some exceptions to that, but the early withdrawal penalty tends to be, or typically is, prior to 59.5. Every dollar, both original cost and appreciation, will be taxed as ordinary income when you take the money out. And basically, you promise to take out every dollar during retirement, which means that the government enforces what are called required minimum distributions, starting at either age 73 or 75. That varies depending on your year of birth. And there are substantial tax penalties if you do not take out what you are required to take out once you reach one of those ages. The custodian that you have your money with is obligated to tell the government if you do fail to withdraw on schedule. So for most people, we're not quite there yet, but once you get to that age, very commonly known, most custodians will make sure that you don't miss on that, but there's a pretty big penalty if you do. Non-qualified accounts. So non-qualified accounts, that's just another way to say non-retirement account. So you can think of your checking account, savings account, a brokerage account as a non-qualified account or non-retirement account, just semantics. So what's the deal with those? All investments on that are made on an after-tax basis. You pay more in taxes every year, meaning that you pay taxes on dividends when those are paid, even if you reinvest them. You pay taxes on gains, appreciation when shares are sold. Buy stock for $5, get it up to $20, sell it, make your $15 profit. Even if you don't take the money out to yourself, you're still owing taxes on those gains. Again, even if it's reinvested. In tax parlance, the gain was realized even if you did not withdraw the cash, as I mentioned. And of course, you don't receive any company match because these are typically personal accounts, not tied to an employer. Some exceptions to that, but we'll set that aside. The good part about this is there is no such thing as an early withdrawal. If you want to take money out at the age of 40, you can. No penalties, nothing like that. No such thing as RMDs. So if you want to let that money go for the rest of your life and never touch it and leave it for beneficiaries, the government will never require for you to take some of that money out and pay taxes on it, other than, again, what the taxes are earned from the investments. Any appreciation would be taxed as capital gains. Two types of capital gains. There's long-term capital gains, which is basically any stock that is held for longer than a year. It'll be taxed at long-term rates. Long-term capital gains tax rates are typically 40% lower than ordinary income tax rates. If a position is sold within a year, it's called a short-term capital gain rate or capital gain, and it is taxed at the same rates as ordinary income. So think your marginal tax rates or your employment income tax rates there. So anyway, what's the deal? NUA basically allows a do-over. You can move assets from a qualified plan to a non-qualified plan. Non-qualified plan, again, is a retirement account. Qualified plan is a retirement account. Think 401k to a non-retirement account, brokerage account, basically. So again, qualified is a retirement account. Non-qualified is a non-retirement account. The caveats to this, it only applies to your employer's stock. So if you work for ExxonMobil, this only applies to ExxonMobil stock within your 401k plan. Can't do anything with the equity units, international units, bond units, common assets, only employer stock. It can include stock received as company match. You can choose which dollar range of shares you want to declare NUA with. I'll get into that a little bit further on. And it must be part of a lump sum distribution from your 401k. The first distribution since what's called a qualifying event. Separation from service after age 55 is a qualifying event, attaining age 59 and a half, or disability. One caveat to that. If you separate from service at age 55, that's one of the exceptions for that 10% early withdrawal penalties, meaning that you can pull money directly from a 401k if you have left the company at age 55, 56, 57, even though you're under the age of 59 and a half, and there's no 10% penalty. You can also do NUA at that point. Now, let's say you don't do NUA at age 55 and you let your 401k stay there. You do have another chance to do it again at age 59 and a half because that is attaining another qualifying event. If you get disabled, in between those ages, that can be a qualifying event as well. Another caveat to that is you have to move everything from the 401k plan. Anything that you do not take as NUA can be rolled over to an IRA, but nothing can be left in the 401k at the end of the calendar year. Benefits, we'll get into that as far as taxation, but it's primarily the taxation on that money is basically better as long-term capital gains rates as opposed to ordinary income. But that's kind of the heart of this presentation. We'll get into that in detail here. So why is it called NUA? NUA stands for net unrealized appreciation. What it is basically is your current stock value minus your cost basis that equals your NUA. Example, if Exxon, I'm going to use Exxon as an example again. If Exxon stock is worth $100, you paid $20 for it, your NUA or net unrealized appreciation is $80. Tax benefit for distributed employer stock means if you have a lower cost basis, that's better. As of course, a higher market value is better as well. So the way it works is that when you take out your savings plan, as we mentioned, you have to move your NUA shares into a non-retirement, non-qualified brokerage account. It could be a joint account, could be a trust account, could be an individual account. In this case, it's a joint account. Anything that you do not declare NUA on, equity units, international units, or other investments within the 401k, or even stock that you do not declare NUA on, that can all move to an IRA. That money will remain tax deferred. It will remain classified as retirement money. So the qualifications, you're only allowed to use NUA tax rules if you receive the employer's securities as part of a lump sum distribution, meaning that you get a one-shot deal. You can't do part of your 401k one year and part of it next year. There's really no do-overs with this. It's a distribution of your entire balance within a single year. It must be first distributed after a qualifying event, as we mentioned. Qualifying events can be your separation from service due to disability. You leave a company after age 55. It can be 55, 56, 57, 58, or you reach the age of 59 and a half. A fourth qualifying event, which hopefully we don't experience, would be death. So this is just kind of looking at a statement and how you can interpret some things. This is using an example of the ExxonMobil savings plan statement. You can see here, we've got it circled in a bright red circle here, what we're talking about, which is Exxon stock. This is the only thing that we can do NUA with, nothing with any of these other investments here. This also is talking about your savings as far as the types of money that are in your 401k. So technically speaking, there are three main types of money in your 401k. There's pre-tax money, there's Roth money, which is not listed here, and then there's after-tax money. They're all treated a little bit differently. The main thing we want to focus on is after-tax money when it comes to NUA. Now, when you're looking at your statement, in the case of Exxon at least, a lot of misunderstanding on what truly is your after-tax money. It's not this, as we are pointed out here, this $278,000. It is actually this, what's called pre-87, post-86 contributions, a fancy way to say after-tax money. What the difference is between this 130, think of that as your principal. That's how much you actually put in on an after-tax basis. The $278,000 balance is your principal plus any growth. Any growth from after-tax money is considered pre-tax money, which means it's taxable whenever you withdraw it. So the true after-tax money is $130,000, and the delta between the 130 and the 278, that growth, might as well be considered pre-tax money. When you roll it over, it just gets lumped in with your before-tax money here. General account, in this case, is just company match. Now, after-tax money, as far as how it grows, is very different than Roth money. Let's say you have the same thing, $130,915 that you put in on a Roth basis. And if the balance was $278,000, all of that is tax-free because Roth money grows tax-free. So again, a little bit of a sidebar there, but just for the understanding of after-tax money, just keep in mind that this is truly what your after-tax money is. This pre-87, post-86 contributions. So once again, just outlining that this dollar amount here is truly your after-tax money. You have options for that. You can withdraw it, just take it out to yourself, that after-tax money, since it's already been taxed. If you took that money out, there wouldn't be any additional taxes. You can get 130 grand without any taxation. You can roll it into a Roth IRA, so that's a lot of money you can stick into a Roth, and from there, it will grow tax-free. Again, while sitting in the 401k, any growth is growing pre-tax, but you roll it into a Roth IRA, from that point on, it grows tax-free in the form of the Roth. Now, there are some caveats for that tax-free growth. We'll get into that maybe a little bit later, but basically it's going to be, you got to reach the age of 59 and a half and at least start a year or started a Roth 5 years ago. So you got to have 5 years and 59 and a half for Roth money to be tax-free. This has been an option since 2015. This can be better than NUA if you're not selling any of the Exxon stock. And the third option for the after-tax money when it comes to NUA is that you can apply it to the cost basis of your NUA shares. It's a way to leverage this after-tax money. I'll explain what that means, but just kind of keep that third point in mind when it comes to NUA. So this is just looking again at reading your statement. Every statement's a little bit different if you're not with Exxon. So, we can look at that and, kind of delve into what the statements are telling us. But in the case of Exxon, these numbers here are your investment elections for future contributions. So basically, whenever you have money come out of your paycheck, it's showing how much is going into what, 5% to Exxon, 70% to equity units, and on here. This is showing how your current payroll deductions are coming out. In this case, 15% before tax. Here's the Roth option. Here's the after tax. Like I said, 3 types of money that can be within a 401k plan. And then there's catch-up contributions that you can do if you're over the age of 50. That catch-up contribution can be done on a pre-tax basis at this point. There are some legislation laws that have come into play, which are going to force for higher income people catch-up contributions to be made on a Roth basis, but that's not for the scope of this webinar at this point. And then the nice thing about the Exxon statement is that they keep track of every single share that you have ever bought and how much you paid for them. So with these Exxon statements, you can see $11 per share, $12, $13, $14, and basically how many shares you've got, the total cost there. So it's easy for us to be able to see what NUA opportunities are there. So once again, current payroll deductions, catch-up contributions are only something you can do once you're over the age of 50. Once again, looking at your investment elections for future contributions, you can see that you can actually differentiate if you want if you're contributing on a pre-tax basis and the general account's again the match, and you want it to go different, you can do that. Most people just kind of have everything go the same way here. So this is a little bit more of a illustration on how when you distribute the savings plan and declare NUA, where everything goes. If you have a Roth 401k, that goes into a Roth IRA. If you have anything that's basically not Exxon stock, common assets, equity units, balance fund, whatever it is, that will have to be liquidated and then rolled over as cash. There's no tax implications. Typically, we move that into a managed IRA. For any shares that we are not declaring NUA on, those will remain as retirement shares. Those go into a IRA as well. We typically move those into an unmanaged IRA. And as mentioned before, your NUA shares will go into a brokerage account, be that a individual account, joint account, or trust account. Another illustration, 2.5 million, cash of 2,500,000 shares of Exxon stock going into a IRA that we did not declare NUA on, 5,000 shares of Exxon stock worth 500,000 going into a brokerage account of some sort. So if there's anything you get from this webinar, this is it. This explains it on a 50,000 foot level, I think. Just really what the difference is. So this on the left, the 100% tax as ordinary income, this is the base case. So if you sell your Exxon stock and take it out from your 401k or from an IRA, everything is going to be taxed as ordinary income when the money is withdrawn, not when it's sold, when it's withdrawn. That's if you leave it in a 401k or an IRA. That's the base case. Now, if you declare NUA, instead of having 100% of it taxed as ordinary income, your cost basis, and remember when I mentioned applying the after-tax money to the cost basis, I'll get to that here, but your cost basis would be taxed as ordinary income, and all of your gains on that particular stock will be taxed at long-term capital gains rates when sold. Key phrase, when sold, not when withdrawn, when sold. So in this example, let's say you again bought a stock for $20. It's worth $100. Your cost basis is $20. The $80 of gain to get up to $100 value, that is what your NUA is. Again, NUA stands for net unrealized appreciation. So now we've got a live example. Let's say you take $500,000 out. In the case of, it's all Exxon stock. You take $500,000 out as a withdrawal to yourself, 100% is taxed at ordinary income. If you take $500,000 out, again, we're assuming we take it out and spend it. In the case of declaring NUA, only $100,000 is taxed at ordinary income. The $400,000 of gain in this case is taxed at long-term capital gains rates. Let's focus on that and get into some more details here. So first of all, let's compare ordinary income and capital gains tax rates. On the left-hand side, should look familiar. These are your marginal ordinary income tax rates, IRA distributions, employment income, your wages. That's what is classified as ordinary income. And then on the right-hand side here is the capital gains tax rates. Now you can see whether your ordinary income tax is low or high, capital gains tax rates are going to be lower. In the case of very little in capital gains and no other income, you could pay zero. In the case of a lot of capital gains relative to ordinary income, 20% plus 3.8 in some cases is still lower than 37%. So wherever you fall, typically capital gains rates are going to be lower than ordinary income tax rates. So let's look at a real example here. Let's say your cost basis is $29.50 per share. You've got 5,000 shares. Total cost is $147,500. Now, let's say you have that after-tax balance that I mentioned. That after-tax money, remember the pre-87, post-86 contributions of $130,000. Whenever you declare NUA, let me come back to this slide here. Whenever you declare NUA, immediately your cost basis is taxable to you, whether you take the money out or not. So upon the declaration of NUA, in this case here, you would owe income on $100,000, meaning it's like you made $100,000 or you took a withdrawal of $100,000. You're not seeing any money, but in the declaration of NUA, you basically have tax liability on the cost basis. So it's like you earned an extra $100,000 in this case. So let's come back to this example. Cost basis, again, $147,500. Upon the declaration of NUA, if you had zero after-tax money, you would have to report $147,500 of income. The nice thing about after-tax money is that you can apply this after-tax money to the cost basis. And instead of owing taxes on $147,500, your taxable portion is only $16,584 because its after-tax money was applied to it. Now, what happens to that after-tax money? Does it disappear? No. Basically, obviously, it wouldn't make sense to, just have that after-tax money go away to save on taxes with this. What happens to that after-tax money, the simplest way to think about it is that after-tax money flips from after-tax money to pre-tax money. So down the road, whenever you withdraw that money, you'll pay taxes on it. Think of it as a way of deferring taxes. So basically, you can reduce the upfront tax costs by applying the after-tax money to your cost basis. So let's look on the tax on a capital gain when sold. Let's say basically you have the value of shares again at 5,000 shares at $100, 500,000. Your taxable cost basis is $147,500. The delta between these two mean that you had a gain of $352,500. Tax on that capital gain at 15%. would be $52,875. Rates, of course, can be higher or lower depending on what your total income is, but in this case, 15%, about 53 grand you own there. Now, the net proceeds of this, again, gross proceeds from the sale of Exxon at 500,000. You got to pay that tax on the cost basis. Again, that's coming back to here where we owe taxes on this 16,584. And that's assuming a 40% rate there, just on the high end. And then basically, oops, sorry, went too far. So tax paid on the cost basis at 6,634. Tax paid on the capital gain, which again, right here, capital gain 352, 15%, 53,000. So you net out after you pay all your taxes, $440,491. Compare that to taking out 500,000 without declaring NUA. The tax paid on the withdrawal is 40%, and now you're netting 300,000. Obviously less. So the net benefit of NUA, if you do NUA, you net out 440,000. You don't do NUA, you net out 300,000. NUA can save you, in this case, $140,000. Not insignificant. So some other NUA factors and sensitivities you want to look at. The factors that favor doing more NUA. If the Exxon share price has gone up or you see it rising in the future. Plans to use NUA sooner, meaning that you need some money soon. Doesn't really make a lot of sense to declare NUA. Well, there's some cases, but a lot of times if you declare NUA just to sell the stock and reinvest it, doesn't really make sense to do that because, again, you're paying capital gains taxes and you can avoid that if you just keep it deferred. So we like to typically use NUA for larger purchases, expenses, income needs for the first few years of retirement, sell those shares, maybe put into something like a money market, draw on it, that type of thing. If you're retiring pre-59 and a half, you can use NUA as a bridge. So you can move that money from the 401k into a non-retirement account, have full access to it. It can be a way to bridge to 59 and a half, basically, if you have enough of that. And also, if you are going to get to the point where the RMDs are going to become a tax issue, meaning that the government's going to make you take out more than what you actually need to spend, well, anything you declare on NUA on and move out of the retirement accounts is not going to be calculated or used for RMD later on. Factors that favor not doing NUA or at least doing less NUA. If you think Exxon's price is going to fall in the future, if you have no plans to sell the NUA shares or you're going to sell them and just reinvest them, or your preference is to have those after-tax contributions flow into a Roth. Now, I'll make a little case for still applying after-tax contributions to the cost basis because you can still do a Roth conversion of that pre-tax money. And maybe instead of doing it all in, if you declare NUA and your cost basis, it's taxable in that year you declare NUA. Whereas you could split Roth conversions over 2 years and basically split the tax liability over 2 years. But again, that's looking at the after-tax considerations. Some people want to get that money into a Roth as soon as possible to get that tax-free growth. Once again, let's highlight some advantages and disadvantages of NUA. Advantages, it's taxed at long-term capital gains rates, not subject to RMD rules, never subject to that 10% early withdrawal penalty, meaning you can take it out and use it at any time. And they can offset taxes on cost basis, and you can offset the taxes on the cost basis with that after-tax paid balance. Disadvantages is the cost basis is taxed at ordinary income rates as soon as you declare NUA or in the year you do it. There's no benefit of tax deferral of any future growth, so you're not deferring taxes in this case. Significant amount of employer stock can lead to a less diversified portfolio, meaning if you have a ton of NUA and you're, trying to whittle that down, like I said, it doesn't make a lot of sense to declare NUA just to reinvest that money because you're paying taxes on it. If you have a very big concentration of Exxon or any employer stock and you're looking to diversify, may want to consider not doing anyway, so you can just sell the stock and reinvest it without incurring any taxes if you have other avenues that you can use for money and cash flow and things like that. Also, the dividends are taxed at your qualified dividend rates. When it comes to Exxon stock or any stock with a dividend, where if it remains in a retirement account, any dividends that are paid out remain tax deferred, like we were talking about in previous slides. So if you're not using the stock and you're not using the dividend, if you declare NUA, those dividends that pay out now, since that Exxon stock is considered non-retirement money, basically you'll owe taxes on that. I think I got a question. Do you have to sell the NUA shares all at once, or can you do it in multiple steps? Great question. You can do it in multiple steps. A lot of times that's what we do, especially if you have a big chunk of NUA that you've done. You don't want to sell it all. Like, let's say you did in November. You don't want to sell it all in November when you can split it over 2 tax years, sell half in November, half in January, and split it out. So you do not have to sell it all at once. You can do it in multiple steps over many years if you want to. Great question. So let's talk a little bit more about pre-retirement strategies. First of all, always review your contributions. Are you saving on a pre-tax, an after-tax, or a Roth basis? Many people I work with that haven't sat down with a financial advisor yet can confuse after-tax savings with Roth savings. Very different as far as that goes. Review your NUA share cost basis and look at that compared to your tax paid. Basically, if you have some very low price shares there can be some pretty good opportunity. Of course, always try and save more if you can. And then carefully consider before selling low cost basis shares, whether that NUA opportunity is there. The Exxon plan will typically allow you, when you sell the shares, if you don't set any parameters around it, it sells the most expensive shares and works its way down. So that's already kind of embedded into the system. At least last we have checked on that. Things can always change. But always carefully look at, what lots you're selling or what shares you're selling before doing that, and we can help with that too. So other post-retirement strategies, estate planning, tax strategy, cash flow strategy, good till cancel strategies, and covered call strategies. I'm going to cover a few of those items here today as well. So estate planning. Your beneficiaries can also enjoy the NUA tax strategy. Not typically the main reason we do NUA, but it's something to make mention of. If you're still holding NUA stock at death, your heirs will pay the long-term capital gains tax rates when he or she sells those shares. Any appreciation from the date of death will forever escape taxation. That's a little bit hard to wrap your head around. I'll give an example. So let's say NUA is $400,000. You die when the stock is worth $750,000. Cost basis is $100,000. The gain or the unrealized appreciation is $400,000. From there, after you declared NUA, the stock grew another $250,000. In this case, at death, basically the $100,000 cost basis has already been taxed. They'll owe taxes on the NUA, so don't escape that. But then they're not going to pay taxes on the $250,000 gain. You get a step up in that, versus if you have basically the money that you had not declared NUA on, all of this would be taxable. So you can avoid some taxation when heirs inherit NUA shares. Now, if you declare NUA and you pass away in 30 years, will your heirs remember that these are NUA shares? Will the IRS remember that these are NUA shares? I don't know. But if they don't, they'll get a full step up in basis, and, we'll see. But basically, I don't know if, how closely the IRS would be able to track that back. But again, technically speaking, this is the way it would work. They would still owe taxes on the NUA portion, but any gains from there, they would get a step up in basis, meaning that they don't owe taxes on those gains. All right, so a little bit more when we talk about cash flow for early retirement. So if you're leaving a company prior to age 59 and a half, first of all, if you have any savings or non-retirement accounts, brokerage accounts, you can use that. You can use NUA shares like we have talked about, part-time work, consulting. Another option, and this is kind of the duality of, do I do NUA or do I do the rule of 55? You can do what's called the rule of 55, where you can pull money directly from a 401k without any 10% early withdrawal penalty. The key word is directly, or the key phrase is directly from the 401k. There won't be a 10% early withdrawal penalty. Now, the caveat to that is that it's got to stay in the 401k. So if you declare NUA, let's say you declared NUA, you had $50,000 worth of NUA shares, sell those shares, and then everything else got moved over to an IRA. If you move that money out of 401k to an IRA, the rule of 55 no longer applies. So be very careful in deciding to use NUA as a bridging strategy. You got to make sure you got enough to truly bridge, because the option is to keep the 401k there and pull money from it, and then you will pay ordinary income taxes, but you'll avoid that 10% penalty. If you move the 401k again to an IRA and then take the money out prior to 59.5, that 10% penalty comes back into play. With the Voya plan, just to keep on the Exxon examples, you can typically only pull money once a year. So it makes budgeting a little bit difficult, but to save 10%, certainly worth it if you can. There are some exceptions to that where you can pull maybe 2 or 3 times a year. But again, for the scope of this webinar, we'll table that for now. Another option is what's called a 72T. That is basically doing equal payments over 5 years or until the age of 59.5, whichever is longer. It's basically kind of setting up like a little mini annuity, more or less. You avoid the 10% penalty, but you can't deviate from how much you take out each year. If you screw that up, very complex, you got to get a CPA to help you with that. But if you screw that up, the IRS will come back and penalize you for all the years that you've been taking that money out. So tread very lightly with that one as well. I tend to try and look at a lot of other options before going this route. And then last route is HELOCs. Have any equity in the home, you can potentially tap into some equity that way. So taxable strategies, there's different types of income and there's different taxability when it comes to different income. So Social Security, typically it's partially taxable as ordinary income. Pension income, if you take the annuity, that's all taxed as ordinary income. Interest income, so think like money markets, savings accounts, taxed as ordinary income. IRA and 401k distributions, taxed as ordinary income. Dividend income, qualified dividends are long-term capital gains rates, 15%. Others are taxed as ordinary income, so it's just a matter of whether they're qualified or non-qualified, depends on the stock. Long-term capital gains are taxed at long-term capital gains rates. We'll show that again here. And then Roth IRAs are, as long as you have made the age 59.5 and have had basically 5 years or 5 years past your first contribution to a Roth, not subject to taxation, no matter how much it's grown, could grow to $1 billion and you're not going to pay any taxes on it. And then liquidation of investment principal, meaning your cost basis. If you bought a stock for $20, you held it for 5 years, you never made any money, you sold it for $20, there's no taxes. Obviously, would rather pay taxes than to buy a stock for $20 and not see any gains over 5 years. Got another question. Once NUA is declared, nothing can be kept in the 401k. That is correct. Yeah, you got to take it all out in the year that you declare NUA. Another question, how to declare NUA? If taking NUA in 5 to 10 years, the rest of the money stays in 401k. So, again, if you declare NUA, all the money's got to come out. How do you declare NUA? You basically call your 401k provider and tell them. Most 401k plans just do it over the phone. There's no paperwork involved. You basically have to call them. You tell them, like, for example, I want to declare NUA on all the shares I bought that I paid $30 or less for. So $30 and below. They'll calculate that out. They'll say, okay, that's 1,000 shares. Your cost basis is this, blah, blah, blah. And you pretty much just do it over the phone. You'll get certain tax forms that you'll have to file. Want to work probably with a CPA on that, and a CPA that knows NUA. Believe me, many CPAs are not familiar with this. This is one of the more complex strategies out there. But basically, yeah, it's over the phone and you've got to just file your taxes right, essentially. So again, work with a CPA that is savvy with NUA if you do go this route. All right, so once again, let me come back to this. So considerations for minimizing tax liability. Hold assets that are generating interest income in qualified accounts. Qualified accounts, again, are retirement accounts. Think 401k, think IRA, think Roth IRA, 403Bs, basically any type of retirement account. If it's generating interest and you don't need the interest as to spend, consider holding that in a qualified account to keep those taxes deferred. Hold assets that are generating dividends or capital gains in non-qualified accounts. I'll say qualified dividends or long-term capital gains in non-qualified accounts. Use distributions from different account types and different assets. So, you can kind of control for your taxes. I like having Roth money. I like having pre-tax money. I like having non-retirement money. All those monies have pros and cons. And a lot of times, having all three of them, you can kind of play around with how you want your taxes to be for the year. You can live off non-retirement money, do Roth conversions because your ordinary income's low. A lot of clever stuff we can do. But having all three is ideal. In my experience, I've done this about 18 years. Most asset levels are heavier in pre-tax money. Just the way it tends to work. Company match goes in pre-tax. Most people save on a pre-tax basis. Roth savings were not an option. I forget exactly when that went into effect, and a lot of 401ks took their time offering that. So most people have most of their money in pre-tax money, at least in the corporate world, let's say. Another thing, withdraw qualified assets before required to reduce future tax bills. I would say instead of withdrawing qualified assets, convert it to a Roth, unless you need the extra money or you want to take some extra trips and vacations or whatever. But withdraw or convert pre-tax money to reduce future tax bills. If you think taxes are going to go up, might make sense to pay some taxes on it now. I would say that taxes are probably going to go up in the future. Focus on maximizing lifetime after-tax income instead of minimizing your current tax bill. Don't let the tax tail wag the plan dog. Again, all this centers around long-term capital gains rates. Once again, you can see if you made nothing else and only had $94,000 worth of capital gains, you're not paying any taxes. That's nice. If you go from 94 in the case of joint to 250,000, you're paying 15%. 250 to 583, they're going to slap on a Obamacare surtax. If you're above 250, 3.8%. And if you make over 583,000 in capital gains, you're looking at 20%. Once again, that's still not nearly as much as if you have $583,000 of ordinary income or wages. All right, so let's talk about, kind of in line with if you do declare NUA and you got that stock, well, how are you going to sell it? So one of the things we like to look at are what are called good till cancel orders. Another phrase for these are limit orders. So let's say that, you got Exxon stock right now, it's at 102 or 103. You're pretty confident it's going to get up to 110, 115, and that's where you'd be comfortable selling it. You can basically set a limit order that if that stock gets up to 115, it will sell it automatically. Now, even though it's automatic and it's supposed to happen, it guarantees you'll get that 115 price. It does not guarantee that the stock will sell. So if it just touches that price for a fraction of a second and then goes back down, the order might not sell. Compared to what's called a market order will sell it at the next available price. It will guarantee that that stock gets sold. But again, if you place the market order, something crazy happens where the stock drops, you're looking at it at 115 and then you sell it, a second later, it drops to 112, well, $3 off. So that's a way to get out of the stock, limit orders, market orders, typical trading that you can do in a brokerage account. I've got another question here. Are there any actions that you might take in your 401k that would later disqualify you from being able to declare an NUA? Yes, excellent question. So yes, if you take a withdrawal, let's say, again, in this example, let's say you reach the age of 59 and a half. That's the qualifying event. You could have had a qualifying event if you left the company at 55 or 56. Again, another qualifying event at 59 and a half. But let's say you retired at 60, just for example. If you take a partial distribution from the 401k plan, and let's say you take 20 grand out, that will disqualify you from NUA. So you can't touch your 401k. If you do take money out, it's all going to come out that year. You got to declare NUA that year. So any money that's taken out after a qualifying event, and if you don't declare NUA in that year, you will be disqualified from NUA. Great question. But let's go back to that qualifying event. So let's say you retire at 57. Instead of doing NUA, you do Rule of 55 and you take money at 57, 58. You're doing partial withdrawals. You can't do NUA, from 57 to 58, but at 59 and a half, that's another qualifying event. You could do NUA at that point. So it gives you another chance to do it there. Again, you could also become disabled, not the ideal. And once again, death is another qualifying event. And we know that's not ideal either. But 55, 59 and a half. After that, if you do take money out and don't declare NUA and a couple of years go by, you're not going to be able to do it. Great question. All right, so now we're going to talk about covered calls options. So another way to kind of utilize concentrated stock or a single stock. So some terms with covered calls. Covered calls are options. There's strike price, time frame, premium, and the underlying stock, which in this example, again, Exxon stock we'll talk about. So what a covered call strategy basically is when a stock investor sells what's called a call option against their shares. They're accepting the option premium as payment for giving up all upside potential in the shares above the strike price. And I think of this as a way to get some extra enhanced dividends. In other words, by selling a call option against 100 shares of stock, you are selling the profit potential on the shares above what's called the strike price of the call you sell. An example will probably help explain this. So in this case, the premium is the dollars you receive for selling this option. The strike price is the agreed possible sale price. In this case, it's 120. In this case, the premium is $3 a share. One call equals 100 shares. That hence 10 calls equal 1,000 shares. So if you sell an option, basically, you're getting $3 per share. So if you sell 1,000 shares, or if you sell an option and you got 1,000 shares, you gain $3 per share. You get $3 premium, basically. So think of that as getting an extra, dividend, if you will. You immediately get that, so it's not, deferred. Someone buys it, you immediately get that cash. There's two outcomes that are going to happen with this. The stock will stay at or under $120 a share on what's called the expiration date, is when that option expires, or the stock goes over 120 on that expiration date, or will be over 120 on that expiration date. So in this example, $100 price is where Exxon's at, and you sell basically a option against it. You'll get $3 for that one share. And let's say in this case, it gets up to 125. If you sold the option at a sales price or strike price of 120, the person that bought that option from you has the right, not the obligation, but the right to buy it from you at $120. And you are going to be obligated to sell it to them at $120. So if Exxon gets up to 125, you were paid $3 for that option, but you missed out on $2. Technically speaking, it would have been better off to just let it get up to 125 and sell it. So this is a way to basically generate some premiums. If you're not looking to sell the Exxon stock, or you're eager to get out of it, but you want to put a little bit of hedge in there. Obviously it's not ideal if Exxon gets up to 200. That's what the person that buys the option from you is hoping for. They're going to pay a $3 premium per share. Hope they gets up to $20 and force you to sell the stock. Force sounds a little harsh, but that's the way it works. They'll make you sell the stock at 120. They'll buy it at 120. It's at 200 at the time that this gets exercised. They'll turn around and sell it for the profit, basically. So tread lightly with these, but it is a way to get some extra premium out of your stock, essentially. I prefer to kind of use these with IRA shares as opposed to NUA shares, because all those premiums, if you do it with IRA shares in a retirement account, much like the dividend, it remains deferred. So it's a way to kind of enhance the dividend if you want, but there's other things you can do with options too. This just kind of looks at an example. So here's the strike price. This was as of January 13th. I can't remember exactly where Exxon was at. Probably around, I don't know, 100 or 99, something like that. Basically, if it's shaded, that means it's in the money. The last price here, this is the premium that people are willing to pay. So Basically, in this case, you're obligated to sell Exxon at 100. They're willing to pay you $10.35 per share for the right to buy Exxon at 100. And then they also have, it's not listed here, but they'll have kind of a period of time that this option will expire. So let's say, for example, you did one of these where you give someone the right to buy Exxon at 125. They pay you $2.56 per share. The option will expire in 6 months. In 6 months' time, Exxon doesn't get any higher than 115. Well, you walk away with your $2.56 premium per share. The option expires. You keep the premium. The person on the other end never gets your stock because they're not going to buy the stock from you at 125 when it's only trading for 115 once the option expires. So like I said, it's a way to get some enhanced premium. If you're pretty confident Exxon's not going to get up to 135, you don't really want to sell it, but you want to get a little extra premium, you can see $1.40 per share. The lower the price, the more they're going to pay for the opportunity to buy it from you. Because if it gets up to 120, and you sold this option at $10.35 a share, it's kind of like when they buy it from you and you have to sell it, it's more like you sold it for $110.35 because you got that premium, but then they're going to turn around and sell it at 130. Obviously better to have held on to it. So again, tread lightly with these, but this is a way to kind of interpret this. Bid ask, disregard that. That's if you're buying and selling options, which is a whole nother thing. I think I may have got another question here. What if you are planning in-plan Roth conversions while you are less than 55? Are there any implications that could negatively impact your ability to do future NUA? No, because basically if you do in-plan conversions prior to 55, you'll have the qualifying event that'll still occur. So 55 and separation, or 59 and a half, so that won't. Now, this is a completely different topic, but instead of doing in-plan Roth conversions, I would encourage you to take a look at our mega backdoor Roth strategy. There's some better options you can do besides an in-plan Roth conversion of after-tax money compared to rolling that money into a Roth. Completely separate topic, but there's better options, I think, than in-plan Roth conversions. Premium is always $3 a share. No, just like I was showing here, depending on what the price is that you're agreeing to sell it at, the premium varies. So you can see if I'm willing to sell it at 100, they'll pay me $10.35. If I'm only willing to sell it at 135, they're only going to pay me $1.40. So obviously a big difference there. All right, so advantages and disadvantages of covered call strategies. Again, these are pretty complex things that can, again, I would recommend speaking with an advisor before doing this, but advantages are you can earn additional income while retaining the stock. Like I mentioned, there is some downside protection since you get that premium paid right at the beginning, and it can be a great strategy to divest shares. Disadvantages is you have a cap on that upside profit. Like I said, if you agreed to sell it at 110, it gets up to 150. You would have, not want to have done that. May, as we've been talking about, be required to sell the stock, and the downside protection is still limited to the premium received. All right, so basically we use this as an invitation to, come talk to us for a one-on-one consultation. No obligation, no commitments. We like to meet with people just to see if you'd be a good fit for us, we'd be a good fit for you. Feel free, to reach out to us. I'll put my contact info in the chat here in a second. But basically, when you're meeting with an advisor, some things you want to consider when you select an advisor: qualifications. CFP is kind of the standard now for advisors, certified financial planner. You want an advisor that knows your benefits, knows your retirement plan, knows IRS retirement rules, has navigated multiple business cycles or has a lot of experience, has managed portfolios, open to discussing various strategies, not kind of a one-size-fits-all, selling annuities to everybody, for example, provides financial planning based on your needs and risk tolerance, not based on what they want to sell you, and provides regular portfolio performance reporting. Always good to know how you're doing. And understandable, speaks in a way you can understand. Hopefully I am understandable. I can talk a little fast, but we have other advisors here that talk a little slower than me. Got another one. Aren't you obligated to hold the stock for the term of the covered call contract? Depends on the type of option, but yes, typically it's at the time of expiration that you'll see that exercise, but there's different types, but yeah, typically you are. And so if you sell the option you are obligated to hold the stock. If you sell it, basically you're going to have to buy it back because the person has the right to, get that stock from you. So you don't want to do what's called a naked option where you don't own the stock and you sell the right to buy it from you. And that gets very risky. But yes, you are more or less going to not be able to sell that stock once you have put an option on it, essentially. Good question. All right. So once again, we invite you to have a one-on-one financial strategy session with us. We can even run an NUA analysis if you have, a statement from your 401k in the case of Voya. We can run an NUA analysis, see what that opportunity is, look at your cost basis, look at the after-tax amount that may or may not be in there, how low your shares are. Exxon obviously has done pretty good. You could keep using them as an example, but Exxon's obviously done pretty good over the last couple of years. So the opportunity for NUA this year and last is much better than it was, say, in 2020. So a lot of good opportunity there that we can find, especially if you're close to retirement. Now, NUA is not really a strategy that you want to be focusing on if you're 40 years old, basically. NUA is a strategy when you're knocking on retirement's door, 55 or older, basically, because you can't do NUA until you have one of those qualifying events. Again, 55 and separation from service, 59 and a half. So basically, you got to leave the company or be looking at retirement soon before you really want to be considering, NUA here. If you're 30 years old, don't worry about it basically at this point. All right, so feel free to contact us with any questions. Let me go ahead and put my direct email in the chat. And let me send that to everyone. All right, there's my email, my number in there as well. Feel free to email me directly if you have any follow-up questions that you didn't want to ask in the chat, or if you want to set up some time with me, or you want to prefer to meet with someone else, feel free to call our toll-free number here. One of our associates can get you set up with one of our advisors here. Thank you very much. That's it. I'll stick around for a couple minutes here to see if there are any other questions that come in. And I would encourage you to look at some of our other webinars. This will be posted on our website. So this has been recorded. Again, it'll be posted on our website. But take a look at some of our other webinars that we have around estate planning, mega backdoor, Roth strategy. Again, that's one of my personal favorites. Love that one. Take a look at that. I'll be doing that again later this year. And then just anything else that you want to talk about, feel free to reach out. Or if there's anything on our list of recordings you want to look at, it's all available on our website. Here's just some disclaimers I got to click through. Yeah, and we're now on Facebook, LinkedIn, Instagram, YouTube. We're going to have more webinars, podcasts, all that fun stuff. And we really appreciate your time.